Thank you for joining today's webinar on portfolio positioning during COVID-19 market volatility, insights from 3 distinct vantage points. My name is Hank Kim, and I'm the Executive Director of NCPERS. Today's program is part of our expanded Center for Online Learning. As I've said previously, we're all adjusting to the new realities, so please bear with us if there should be technical issues or errant background noise during our webinar. As always, your patience and understanding is greatly appreciated. Today's webinar is sponsored by Northern Trust Asset Management. Let me start with a few words about our sponsor and then introduce the presenters. Northern Trust Asset Management is a global investment manager that helps investors navigate changing market environments so that they can confidently realize their long-term objectives. Entrusted with $1 trillion in assets, Northern Trust Asset Management understands that investing ultimately serves a greater purpose and believes investors should be compensated for the risks that they take in all market environments and any investment strategy. That's why they combine robust capital market research, expert portfolio construction, and comprehensive risk management to craft innovative and efficient solutions that deliver target investment outcomes. As engaged contributors to their communities, Northern Trust Asset Management considers it a great privilege to serve their investors and their communities with integrity, respect, and transparency. Our presenters today from Northern Trust Asset Management are Jim McDonald, Brad Camden, and Eric Nosey. Jim is an Executive Vice President and Chief Investment Strategist for Northern Trust. He is responsible for overseeing the strategic and tactical asset allocation policy for institutional and wealth management clients globally. He chairs the Northern Trust Tactical Asset Allocation Committee and is co-portfolio manager of the Northern Global Tactical Asset Allocation Fund. Brad is head of fixed income strategy for Northern Trust Asset Management. Brad's main responsibility is to head the taxable active long duration strategy team. He has oversight and portfolio management responsibilities across a variety of both active and passive strategies. He is chair of the Fixed Income Credit Strategy Committee and member of the firm's Tactical Asset Allocation and Investment Policy Committees. Eric is Vice President and Senior Healthcare Analyst for Northern Trust Asset Management. Prior to joining Northern in 2018, Eric was head of the sector head of healthcare at Calamos Investments, where he directed a team covering the healthcare industry. We encourage audience participation. Please submit your questions by using the GoToWebinar portal. However, to ensure that we can cover all the topics during our session today, we will hold your questions till the last part of the program. Jim, Brad, Eric, I'll turn over the program to you now.
Great, thanks, Hank, and good afternoon. I'll start with the table on slide 4. And as background, we've been trying to estimate the trajectory of the coronavirus since back in January, and we wanted to make an objective analysis based on clinical information and real-time data to provide a framework for our investment process. And the big caveat here is that the data continues to evolve on a daily and weekly basis, so it should be relied on with some caution. And just so you know how we're staying on top of this, we've been listening to conference calls with epidemiologists, doctors, lab directors. We've been reading the scientific and medical literature and trying to model events, and all of that goes into our thought process. So to begin with, on this slide, we compared COVID-19 to other outbreaks in recent history. And shown here are 2 prior coronaviruses, SARS and MERS, and 2 influenza viruses, H1N1 and seasonal flu. And when we compared these viruses on clinical metrics, including mortality rates, COVID appeared to be framed characteristically somewhere between those 2 groups of viruses, with a mortality rate on the order of 1%, which is lower than SARS and MERS, but higher than H1N1 and seasonal flu. But COVID has been so much worse than those 4. And so why is COVID so different? Well, it's really the hospitalization intensity and the heavy burden on the healthcare system and the healthcare workers. That's what stands out. We've estimated that about 300,000 patients could be hospitalized in the US, which is of similar magnitude to H1N1 and seasonal flu. but clearly it's worse because of the toll on healthcare workers and the intensity of patient care that overwhelms the surge capacity of the system in some areas, plus our lack of adequate PPE. So we think this hospitalization intensity is an important factor as we evaluate what the off-ramp could look like. In other words, how will we eventually get clear of this disease or approach a steady state similar to seasonal flu? Will it be a vaccine or continued social distancing, or as some have suggested, just allow the virus to grow and we can build up herd immunity? But for all of those solutions, our hospitalization capacity is the key limiting factor. And so what does all this mean going forward? Well, unfortunately, there's no clear answer right now. And as you know, there are various models out there that project mortality estimates. One is called the Imperial College model, which estimates 2.2 million deaths in the US, and that assumes no mitigation. That's just allowing the virus to run. And we think that's an extreme estimate, but it's something to consider as governments contemplate how to open up the economy. There's a model favored by Dr. Fauci and Dr. Birx, and that estimates mortality at 100,000 to 240,000, and that's with mitigation efforts. And then there's the model called the IHME model, and that's cited by the White House and Dr. Birx, and that's now predicting US mortality of 68,000 with a range of going up to 120,000. And this is the model that we've favored, and we believe there is a path to containment with those mortality numbers in this lower range. But there are many variables that will impact the outcome, and importantly, a key variable in modeling total mortality is how much social distancing is enforced and followed, because that will impact the tail of that curve. So if we go to the next slide, we'll look at the COVID-19 trajectories of mortality in 3 global zones. So each zone illustrates a unique situation, and this chart shows mortality per day on a log scale. And the key area to focus on is the slope of the curve on the right side of the chart, which represents current trends in daily mortality. The first zone we look at is South Korea at the bottom of the chart. We see that as the gold standard for preparedness. They used high-tech measures for containment, which included GPS contact tracing, widespread diagnostics. They tracked visitors to the country using contact tracing mobile apps. And so you can see that they were able to bend the curve early in the outbreak and are now almost back to zero mortality, which is very encouraging. But they're still maintaining strong surveillance, and they have not yet opened up the economy fully. It's possible that South Korea and other regional areas such as South Korea and Hong Kong could be a model for what the future looks like in the US during a containment phase this year. For example, in some of those countries, schools are open, restaurants are open at half capacity. And if we look at real-time data that tracks mobility within cities, it's about 30 to 40% of normal activity levels. The second zone shown here is the US and Western Europe, which includes here on this chart, the UK, Spain, and Germany. And each of those has now plateaued and looks to be trending down. We would say if there is a desirable model for the US and other EU countries, it could be Germany, which has had relatively good results based on widespread diagnostics. And you may have seen last week that Angela Merkel announced a slow and staged return to work, which is a good sign. But restaurants stay closed, and there will be no large events until August 31st at the earliest. And so we've looked at real-time data on mobility and other activities around the world, and we think a bulk of activity in the US began to shut down around March 19th. If that's correct, then we think we should see the US curve continue to turn downward from here and into early May. And we believe we could see a similar pattern on the other European countries. The third zone shown on this chart is India and Indonesia. And these are important because they have large populations, they are geopolitically important, and they have uneven healthcare infrastructure, which gives you the possibility of becoming a humanitarian crisis. They're also significant for the question of whether the virus is less transmissible in hot and humid climates. And that's important as we consider the possibility that the virus could subside in cooler climate countries such as the US as it warms up in the summer. There's a potential hint here that there is a climate effect, but it's too soon to say, and it's clearly not completely halting the virus. But there are questions about undercounting in their data, and it's possible that the true mortality is actually similar to what's seen in Europe and the US. So we're watching these numbers very closely for clues on the global trajectory of the virus. And on the next slide, slide 6, we've been estimating the forward timelines on a rolling basis. And because the mortality curves appear to be leveling off, everyone is now focused on the shift from COVID mitigation back to containment. And so, as is now generally accepted, widespread diagnostic testing is the key ingredient for returning to containment. We've done about 4.5 million swab tests in the US to date, and that represents less than 2% of the US population, and it's at about a rate of 150,000 tests per day. And this is the swab test that detects active virus. We believe we need to get to at least 250,000 tests per day, or a rate of almost 1% of the population every 2 weeks. So it would be ideal to get to twice that rate, or 1% of the population per week, but it's doubtful we can get to that level in the near future. We also need to improve, we need to improve turnaround times for the tests, and we need to start testing non-symptomatic individuals. And I just saw in the news that California has become the first state to start doing that, which is a good sign. You've probably also heard about the antibody tests, and this is the blood-based test that looks to see if an individual has antibodies to the COVID virus as a way to see if that person had been previously infected, maybe without knowing it. And theoretically, those individuals could resume their normal routines, and maybe they could go back to work. But in our view, there are still many unknowns about this test. For example, we don't know how accurate they are, and we don't know if every person develops antibodies. And most importantly, we don't know if the presence of antibodies gives a person immunity to reinfection. So in our view, we should not count on the antibody tests just yet, but if they do work well, then we think it could accelerate our path to a recovery. In terms of timelines, we had previously estimated a peak in US cases in April, and now we think mortality numbers could decline into May or June. And at some point in May or June, if the US case numbers are low enough and the diagnostic tests are widely available, we think it's feasible that some states could begin a first phase of containment. This is a hypothetical prediction because it really depends on local government decisions. The Trump administration has outlined 3 phases for the recovery, and the initial phase is dependent on seeing 14 days of declining cases in the state. But it's unclear if state governors will use these guidelines or adopt their own criteria. We've already seen that the governor of Georgia has decided to move forward before meeting these guidelines. So we believe most states could move forward into a phase 1 that is similar to the guidelines from the White House starting in May or June. And this could include potentially visits to doctors, dentists, barbers, and possibly some businesses restarting with employees staggering, and maybe having some social groups of smaller size. And after that, if we can eliminate most cases of community spread, then we could move to the next phase in July or August. And that could allow for larger groups such as religious gatherings and restaurants, but with maintained social distancing. And if we can continue to contain the pandemic, then we might allow larger activities such as sporting events and conferences into the end of the year. So again, this is a hypothetical framework. It could vary widely by state, and there are a lot of unpredictable political factors, but we wanted to have some idea of how the off-ramp could play out. So what are some of the variables for the containment phase? Well, one key factor is the effectiveness of social distancing by region. Already we're seeing some differences with evidence that California and Washington state have lower mortality curves, and that's likely due to more effective distancing. So it's possible that some of those states could gradually start to move towards containment measures earlier. We think that having a large stockpile of high quality PPE is necessary for moving forward. We think that the availability of mobile apps that can be used for contact tracing could be a key ingredient, and Apple and Google have partnered on an app for that purpose, and that could launch in May. Herd immunity is a topic that is sometimes discussed, and we think it's unlikely that this will be a solution. Importantly, the percent of the population that needs to have immunity for herd immunity to work is thought to be on the order of 70%. And if we are currently no more than 5 to 10% in the US, then it's unrealistic to expect for herd immunity to work without a vaccine. So moving to the next slide, where we review our thoughts on potential drugs and vaccines. The message here is that we do not place a high probability of having a treatment or vaccine over the next 12 to 18 months. We think it's more likely that public health measures will be the solution to this outbreak. And I've been covering the biopharma sectors for many years, and it's very rare for drugs to be effective in 90 to 100% of patients or represent a cure. So if a drug has moderate efficacy, which is most drugs, then they have to run very rigorous studies to prove that it works. The trials need to be well controlled. You have to have a large sample size, and this is even harder to do in a chaotic setting, such as the COVID-19 treatment setting. So I'll just go through some of these most discussed therapies. The first one is remdesivir from a company called Gilead. We believe that's the best hope for treatment, but we would still apply just a modest probability of success on the order of 30%. And we expect to see more data for this drug in April and May. It's important to remember that this drug is intravenously delivered, so it's only for hospitalized patients. This is not an oral drug that would be widely used. The next drug is hydroxychloroquine, and there have been high optimism for this drug, but more recent data that's come out over the last couple of weeks has been less positive, and there are safety questions with this drug. So from the start, we had placed a low probability of success for this drug having an effect, and we'd estimate now something on the order of 10%. The third category is antibodies, and there are two types of antibodies for COVID. The first type of antibody suppresses the immune system, and that prevents the body's own immune response. That's something called cytokine storm. And we've seen this be effective in some oncology settings. And this is something that could stabilize the patient, but it doesn't necessarily represent a cure. The second type of antibody is are antibodies that are taken from an individual who had COVID and may have built immunity. This is something called convalescent antibodies. We also see for the entire group of antibody category of treatments, a modest probability of success, something on the order of 30%. Actually, it may be one of the better hopes, but it probably doesn't represent a cure. The last group is vaccines, and there are some who say the pandemic won't be fully over until we have a vaccine, and they're counting on 12 to 18 months to have a vaccine, but we would be more cautious. And it's important to note that for products for disease prevention, there's a higher safety hurdle than for drug treatments. And there are high quality companies working on this, including J&J, GlaxoSmithKline, and Pfizer. But the challenge is you do need large trials just to show a benefit. You need long-term safety data, and there are challenges to manufacturing. So we've seen a company called Sanofi say that they expect to have a vaccine in 12 to 18 months. J&J said potentially in 12 months, and we heard a representative from the NIH say potentially even this year. But we think that vaccines have a reasonable probability of eventually working, but it likely takes longer than 12 to 18 months. And I don't want to sound too negative. The bottom line is that we think we have to rely on public health measures over the next 12 to 18 months to contain COVID, but we think it can be done even without a treatment or a vaccine. But if those were to occur, that it would accelerate the recovery. So with that, I'll hand it to Jim.
Okay, Eric, thank you very much. So I'm going to talk about positioning portfolios to weather the storm. And first, I also want to acknowledge how difficult a time this has been for all of us on the call. We appreciate you giving us your time, and not only has your personal life been disrupted, but certainly dealing with public employee retirement systems and dealing with the stress that state and local governments are under from a funding standpoint makes this an incredibly challenging time, and we hope that you're doing as well as can be expected, both personally and professionally. What I want to talk about is our process and thoughts on how we're looking at the world today. If we go to the slide, positioning portfolios to weather the storm, that will start off my section. And I want to spend just a minute talking about process. So we have two distinct asset allocation strategy recommendations: tactical, which are a 12-month time horizon, and then strategic, which we update every summer. And it's important to have these two time frames and to not intermingle them, because there is a big distinction today in what we're able to make an educated guess on and what we really need more time to be able to assess. So, for example, there are concerns that the significant amount of stimulus that the governments globally are enacting will be inflationary. To us, that is a long-term issue that needs to be assessed after considerable debate. And thankfully, our updated capital markets assumption process happens this summer, starting late in May. So we'll be able to tackle the longer-term implications of the coronavirus on things like inflation, things like deglobalization and interest rates in a more considered, deliberate manner. On a tactical basis, so on a 12-month basis, we have been meeting very frequently on an unusually quick schedule during this period. And we have been very blessed to have Eric's input, who is a PhD from Johns Hopkins, running through all of the health data for us, because we do think that health policy is the key. And a little bit of an advertisement for a report that we'll be issuing probably by the close of business tomorrow, with one section of it being Eric's input and commentary on the way forward, the schedule, and how we may reopen the economy. So let me go to the next slide and talk about the markets for a few minutes. So the slide entitled Bear Markets Analysis. So let's talk about what we're facing from a financial market standpoint and what the goals of policy should be. So what I have charted here is the history of bear markets and how long they have lasted for the decline and then the recovery to the prior peak levels. And we've broken the markets into three different types of bear markets. The least damaging being event-driven, which this seemed like at the beginning it might be. The middle being cyclical, which is a more typical cycle where you have inflationary pressures leading to interest rate hikes, which lead to a downturn in the economy, and then we have a cyclical recovery. And then the most injurious, which are structural recessions, where we have significant financial system distress that leads to problems with credit creation that extends the length of the recession and the bear market. So at the highest level, what policy goal is to move this bear market towards the right, to reduce the risk that this becomes structural in nature and becomes cyclical. It's probably, when you look at the return numbers, too significant to be an event-driven one, but being more in the cyclical camp or somewhere between the two is maybe the likely outcome. So how are policies garnering attention to try and address this? There are three policy levers that we're focusing on. First is the fiscal policy, then the monetary policy, and then health policy. And to give you a punchline on each of them, fiscal there has been a lot of fiscal, and there will be more coming if it is needed. On the monetary policy side, it has been better than expected. There were a lot of concerns about how responsive the Federal Reserve would be in particular, and they have gone above expectations. And then on the health policy front, there has been good progress, but there's definitely more needed, as Eric has mentioned. But I want to spend a minute with a further discussion about the bear markets. On the next slide, we'll look at the returns that have been experienced during bear markets, where again, you have the least difficult experience during event-driven bear markets and the worst during structural. So again, the policy goal being to push things to the right. Now, this is a little bit artificial when you look at the rebound. So if you look at an event-driven bear market, the magnitude of the recovery and decline, 27% average drawdown, and the next 12 months shows a very hearty 30% return. It's a little bit artificial. While it's factually true, it is artificial in that it looks at the bottom of the market, which you never know until retrospective analysis. But the history does show very strong rebounds after the bear markets are completed. This one was extraordinary in its speed, with a 35% decline in a single month, and then a 27% rebound within a 3-week period. And then also the volatility at just under 5% average daily volatility during this period was an extraordinary occurrence. So let's review the policy inputs that we think will help to deal with the structural and cyclical issues that we're facing in the markets and in the economy. So if we go to the fiscal policy responses, we've just labeled out in the next slide, some of the key initiatives that have been put into place both in the U.S. and across the globe. And the message again is there has been a lot of fiscal policy put into place, and there will be even more coming down the path. So if you could move to the slide that's entitled Fiscal Policy Response, please. And one of the keys on fiscal policy response is income replacement, and then secondly, credit backstop. And so income replacement is so critical because of the ballooning job losses that we have experienced. Something on the order of 24 million people have applied for initial unemployment over the last 4 weeks. And if you looked at the March job report, there's one silver lining in a terrible number of jobs that were lost, is that 80% of the people who reported losing their job said that it was a temporary job loss. And that's what the income replacement plans are meant to help cover, is that temporary loss of jobs, and that's the goal. Now, we've done some things also from a policy standpoint to increase unemployment benefits, an extra $600 a week, which also this is going to be analyzed in our upcoming report, shows you that in many big states, that gets workers close to the median earnings levels that those states generate. Now, it's a reasonable supposition that the first people laid off might be service workers and might be lower than median income. So the amount of income replacement could be pretty sufficient relative to history. It's creating a bit of a perverse incentive for some employees who may choose not to go back to work if they make more money on unemployment. But the bottom line is this is something that is going to be able to cover a significant amount of lost earnings during this period that could be up to 9 months. Now, from a credit backstop standpoint, another part of the key fiscal response has been moved by the Federal Reserve, both from a monetary and a fiscal standpoint, to do everything they can to prevent the liquidity crisis, which has gone through the markets, which Brad will talk about, turning into a credit crisis. And so let's talk quickly about the monetary policy responses. And then since Brad will likely cover some of this, I'll be a bit brief. So looking at the next slide of monetary policy response, it has all been about the liquidity programs. And they have had significant positive impact on the financial markets. The Fed stepping in to buy assets in a broad range of categories beyond what they did during the financial crisis, to include things like fallen angel bonds, those investment grade bonds that have been downgraded to high yield, or buying high yield ETFs, recognizing the evolution of the market since the last time, have been positively received. And it has led to some improvements in liquidity and spreads, which Brad will be covering. So the final thing I would mention on this is that it has led to improved normalcy. We're not back to normal, but the fact that the investment grade bond market has been very active is a good sign that gets to that primary point that I mentioned, a goal of preventing the liquidity crisis from turning into a credit crisis. So then the next slide gets into the health policy side, and I'll be brief on this also because Eric has covered this. But Eric has been incredibly helpful to us in saying consistently that we were going to see a peak in cases at the end of March or in April across Western Europe and across the U.S. And I think that has been one of the factors that has underpinned the rally that we have experienced in the markets over the last month has been that social distancing has had some positive impact, and then in conjunction with the significant monetary and fiscal policies that have been undertaken. So what we'll be focusing on is the risk of a second wave. What happens in the fall? Is contact tracing in place? Is increased testing in place to be able to manage this and allow the economy to then restart? So if we go to the next slide and talk about the earnings picture for a few minutes, this is a bit of a similar analysis to the bear market analyses, which is what has happened to earnings in prior downturns and reminding people that they always come back. And so even if you go to the great financial crisis, where earnings fell 45% in 2008, they rebounded 57% over the next 4 quarters. Now, of course, the math shows that that does not get you back to 100, but what it does say is that the markets will be focusing on that kind of a rebound. It is way too early to have confidence in being specific about the numbers at this point. The market doesn't care about first quarter earnings, really doesn't care about second quarter earnings. What we'll be looking at is 2021 earnings, and will the economy be rebounding and allowing earnings to grow? Our current expectation is about a 20% decline in earnings this year and about a 22% increase next year, but you have to take those with a grain of salt. But we do expect a dividend cut of around 20% and a cut in buybacks of around 50% because of the strain companies are under. The logical question we get is, won't that be a hindrance to market performance? That is a typical experience you have during a recession, and the markets tend to work through it, and then those tend to start growing back again as the economy improves. A couple final slides looking at market signals and then asset allocation positioning. So what we understand is that we're not going to be able to wait for the data to significantly improve to decide that the markets are going to perform better. The markets are a forward discounting mechanism. The data is going to be awful for months to come. But what you've seen is forward-looking indicators showing some sense of healing, whether it's the VIX index, which got above 80 and has now come down to around 40, or it's what's happened with investment-grade bond spreads. It is showing some sign of healing. When the market doesn't go down on bad news, that is a good sign that investors have repositioned their portfolios and are positioned for things to start to improve. Not that all things are roses. I'll wrap up with some of the risk cases that we're facing, but these are a sign of some improvement in prospects. So let me finalize with some comments just about our positioning. The final slide, tactical positioning favoring U.S. assets. During this market move, we've made small moves in our asset allocation. The market moves have been so fast, and the risk of being wrong and missing the significant rebound that's occurred has been too great for us to be too bold. But during this period, we have very much favored U.S. assets. So whether that's U.S. equities at the expense of emerging market equities, or whether that's U.S. high-yield bonds, those are some of the most distinct trades that we would recommend here with fresh money. So finally, what are the risk cases we're worried about? They're both tied to fiscal policy, so they're somewhat different sides of the same coin. The first is that fiscal policy might prove insufficient to offset the impact of the coronavirus. How could that happen? A negative second wave affecting countries that have already been hit, that leads to an overwhelming need for fiscal that just can't be met. The other risk we worry about is the risk that fiscal policy does create a secular inflationary problem. Right now, the markets are sanguine about it with the 10-year TIPS break even around 1%, but we'll be paying attention to that, debating it this summer, and we'll be updating and issuing our new capital markets assumptions with 5-year forecasts the middle of this summer, so keep an eye out for that also. So with that, let me turn to Brad to talk about what he's seeing in the fixed income markets.
Thank you, Jim. And just to echo Jim's comments, thank you again for your time today. I know everyone's busy and dealing with a lot of variable things. But today, I'm going to talk a little bit about the fixed income market. My section is titled Navigating the Fixed Income Market. I'll provide an overview of bond market liquidity, our outlook for interest rates and credit spreads, and then finally, overall fixed income portfolio construction. If you wouldn't mind turning to the next slide, I'm going to continue the conversation from Jim and talk about the bond market liquidity. As Jim mentioned, there were some significant physical as well as monetary policies that helped stem a liquidity crisis and going into a credit crisis. But if you're not in the market every day, particularly the fixed income market, you are not witnessing or did not experience the extent of damage that was done during the mid-month of March. We saw asset classes from money markets, investment grade bonds, high yield, even municipal bond markets all freeze up. And so I thought I'd provide some context here on what was going on. And to do so, I'm using what's called the bid-ask spread index provided by Market Access. And this is actual bonds traded during the month of March. And so it doesn't give a perfect representation of what was going on, but it does show an example. And so what you see here on the left-hand side is the bid-ask spread in dollar terms. Prior to the crisis in March, to trade a corporate bond, an investment-grade bond, it was about 18 cents. As the crisis started accelerating during the month of March, that spread or that cost significantly increased, and increased almost tenfold to $2 to trade a corporate bond. This is when, on March 23rd, the Fed stepped in and we saw the lows, and since that time, that spread has come back close to normal. When I think about liquidity in the investment-grade market, we're about a 6 or 7 on a scale of 1 to 10, with 1 being the worst and 10 being the best. So we're seeing improvements, but it's going to take some time, particularly getting in traders back into their seats in New York to help facilitate liquidity and understand risk. The good thing is, with all of the support from the Fed and the buying initially of $75 billion of treasuries a day, now they're buying $15 billion a day, the liquidity in the risk-free market, that is the U.S. Treasury market here in the U.S., the liquidity there is now a 9 out of 10. So it's much improved, and the Fed has done an outstanding job of helping mitigate this liquidity crisis. If you go to the next slide, I want to spend some time talking about interest rates. We've seen a significant drawdown in economic activity. Jim just talked about inflation and our view where inflation is expected to be low for a continued period of time. And so here are interest rates across the globe. We have the U.S. Treasury market on the left, the European benchmark, which is the Bund market in the center, and the Japan sovereign debt market all the way to the right. Not surprisingly, year to date, the U.S. market has rallied the most. They were the furthest from zero as the Fed was increasing rates over the last couple of years. But the most important point here is that we expect rates here in the U.S. to grind lower, particularly out the curve, as this crisis and economic activity remains slow ongoing, and inflation remains elusive. In the European market, we expect interest rates to be a little bit lower, but they're going to stabilize where they are. In Japan, it's going to be dependent upon the Bank of Japan's policies. They're out today talking about unlimited buying. We'll see that if that occurs down the road. With respect to monetary policy makers, Jim alluded to a little bit, but we anticipate the central banks globally, particularly here in the U.S., to be engaged for an extended period of time. And so this is not a V-shaped recovery as we've had in event risk or event-driven crisis. This is going to be a long, prolonged crisis that will keep the Fed and interest rates near zero for an extended period of time, likely years. And so our view is don't worry about rising interest rates. Focus in on other asset classes where you can be paid. A few questions that clients are asking us today, and I just want to bring it up. The clients are asking, will the central bank here, will the Fed take rates below zero? Our answer is no. 1, because they said so, and 2, because negative rates globally have not helped generate economic activity. And here in the U.S., we have a very large banking and money market system that actually may do more harm than good if rates were at zero. So expect rates to remain low for an extended period of time. Don't worry about inflation, and expect growth to remain slow even after the recovery. Moving on to the next slide, I want to spend some time talking about credit spreads. As Jim mentioned, there was a significant drawdown in risk assets that was also seen here in credit spreads during the month of March. It was abrupt. unlike past episodes, which we have here, we have 2 decades of OAS spreads, which are the spread over the risk-free assets. Going back to the early 2000s, where we had a recession here in the U.S., you see a small blip in credit spreads, both in investment grade and high yield. We look towards in the center of this chart here in 2008, 2009, you see a significant increase in credit spreads, but that took place over about 18 months, and it took time for the policymakers to respond to that. What you see here all the way to the right is a significant risk-off episode followed by an astonishing monetary and fiscal policy response to stem the bleeding. As a result, we expect, we anticipate that we've seen the wides in credit spreads. With respect to the investment grade market, credit spreads currently stand about 200 basis points. That is a normal level for recessions, and we expect the spreads to bounce around here, but we do see some significant opportunities, which I'll get to next, in various parts of the credit market, as well as in the quality buckets. With respect to high yield widened out significantly, going from the low 300 spread all the way to 1,100 basis points. It's now about 750 basis points, and we do expect more tightening in the high yield market, about 100 basis points. And if you saw from Jim's earlier slide, high yield was one of our highest conviction trades. We still think that asset class will generate a return over the next 12 months after already appreciating about 15% from the lows of about 10%. So still some room to go and still some opportunities in the credit markets, particularly the high yield market. Moving on to the next slide, just to give you an idea of how credit quality has behaved. That is on slide number 21. Not surprisingly, across the board in the investment grade and high yield market, the investment grade here in the green, which ranges from high AAA to low single A or low triple B. It's not surprising that higher quality assets, given the risk-off episode and the extent of the crisis, performed well, and the lower quality within investment grade triple Bs underperformed, generating a return of negative 2.2%. You also saw the same relationship in high yield, with double Bs down 5.4% and triple Cs, one of the lowest quality rungs in the high yield market, down almost 20% at 19.6. I want to point out, though, that if the Fed hadn't stepped in, this would have been dramatically worse. In fact, during the month of March and early April, the highest quality buckets were underperforming the most. So, investors were trading what they could, and those high quality assets significantly underperformed. But after the Fed stepped in, they've also rebounded the quickest, and you can see those returns across the board. Where there are opportunities in the marketplace today, we see most opportunity in the investment grade space in the A and triple B rated securities, as they have not performed as well year to date. And then in high yield market, we see opportunities in both double Bs and single Bs. There are select opportunities in triple Cs, but we're highly concerned about those businesses being a going concern and highly concerned around default expectations and defaults. So I'll get into more of that here in a second, but let's talk a little bit about that on the next slide, which shows the high yield market, its quality. I think it's important to provide some context around how well the corporate management teams have done over the past decade in being defensive, particularly in high yield market. It's important to recognize the starting point with which we've entered this epidemic. And so there's been lots of talk over the years about issuers issuing debt, doing a lot of share buybacks, investing in unprofitable projects, etc. And while that may be the case for some issuers, in general, that is not the case. In fact, when you look at the high yield market, it's never been of higher quality. And so when we compare quality over the last 20 years, the double B market now averages about 54% of the high yield universe. That's 12% higher than its 20-year average. And so 20-year average is 42, the current is 54, it's high quality. And that also extends all the way down into triple Cs, where you see 12% in triple Cs compared to a long run average of 15. So corporate management teams have done an outstanding job of maintaining their margins, generating positive free cash flow, being disciplined with which projects they're investing, and most importantly, they've turned out their debts so they don't have a lot of near-term issuance during this volatile market. If you move on to the next slide, I want to go over a little bit of our default expectations. I haven't provided a full range of default numbers going back to the global financial crisis, but to give you an estimate of what occurred in 08 and 09, the average default rate there was 16%. The long run average is 4.1%, and you can see over the past several months, we've been slowly upticking to now 4.7% default rate as of the end of March. It's our expectation that over the next 12 months, this default rate will increase to about between 10 and 12%, mainly driven by the energy sector. The energy market has been extremely volatile given the price of oil, with oil just a few days ago for the front month delivery in May going below zero. So, commodity prices are all over the board. Energy has been extremely volatile, will represent about 30 to 35% of the defaults of that 12%. But other issuers will also be impacted just given the extent of this economic drawdown, particularly in certain sectors like retail, transportation, and even some of the wirelines that have been struggling over the last couple of years that don't have significant data centers and don't have significant wireless exposure. So we've seen a couple of those occur over the last month, and as we get to the end of April, we expect this default rate to move up quite significantly. The important thing to note, though, is that even though we're anticipating defaults of increasing to about 10 to 12%, this is already priced into the market. So the high yield spread right now is about 750 basis points, which represents about an 8% yield. That is indicative of the current market environment, the current expectations around default. And so when you take that into consideration, as well as all the physical and monetary backdrop or stimulus that's ongoing, we think high yield is an extraordinary asset class that will generate over the next 12 months about 8 to 10% total return. And then lastly, before handing it back, the next slide, I want to talk a little bit about portfolio positioning. This is our best thoughts, as Jim mentioned. He talked about the overall multi-sector portfolio. This is just within fixed income. So this is how we're positioning across our fixed income strategies. Not surprisingly, given our view on interest rates, with the expectation of them moving lower, we have a long duration positioning profile. We're also underweight cash and treasuries. Treasuries have rallied significantly year to date. Credit spreads have widened. We see opportunities in other areas of the market. TIPS, we're underweight as well, given our expectation on inflation. Right now, 10-year break-evens are about 1%. We expect that not to change for the foreseeable future. Inflation has been lagging now for several years, and this epidemic will not change that in our view. With respect to investment-grade credits, we are overweight. As I said earlier, we're not expecting credit spreads to grind in significantly, but there are opportunities within that asset class. Most importantly, we think short duration and intermediate credit will tighten and provide a great opportunity for overall total return. That return expectation over the next 12 months is about 4%. Longer dated credit is neutral. When you look back at what occurred over the last month or so, long dated credit hung in there very well. Credit curves flattened, meaning the short end and intermediate part of the curve widened out a lot more than longer dated maturities. And so right now we see the short dated part of the market is our highest conviction trade, with the intermediate part of the market the second one. The mantra goes, buy what the Fed's buying, and they're supporting the market in the 0 to 5 maturity bucket, and we're going to follow that for now. With respect to securitized are asset-backed securities. They buy, credit cards, auto loans. It also is agency mortgages and other type of collateralized instruments. Right now, that is rebounded quite dramatically from the lows of March 23rd, and we're neutral on the space just because we think there's other opportunities elsewhere, but they have historically been a high-quality asset class to invest in and been compensated from a risk perspective. And then lastly, we have our high-yield allocation. Not surprisingly, we are overweight given that return profile. You're getting almost equity-like returns in the least risky risk asset. That's how we view high yield. And as I said, we expect a return of 8 to 10% over the next 12 months. There will be significant hiccups, and high yield has underperformed equities in this recovery, but we do expect high yield to perform well over the intermediate to longer time frame and driven by those higher quality issues. So with that said, I'll turn it back to Hank, and we'll move on from there.
Great, thank you. Thank you, Jim. Thank you, Eric. Thank you, Brad. We have about 9 minutes. I encourage folks who are still in the with us to submit questions using the GoToWebinar portal. We do have a couple of questions. Eric, let me start with you. So in terms of sort of the best case scenario where there is a vaccine that's found to be effective and safe, what's the timeline for producing, at least here in the United States, about 330 million doses, and worldwide close to, I guess, 7 billion doses?
Right, that's a great question. And there are many different technologies that are being used now to try to develop vaccines. Some of these are brand new technologies that have not been used before, but they could be faster than others. And some companies are using traditional vaccine techniques. And I would just say that there's no guarantee that we will have a vaccine. And if you look historically, for example, Merck developed a vaccine for Ebola, which they just launched last year and sent to West Africa. But that was 5 years after the Ebola outbreak of 2014. So that's just one representation. In another case, we've been working on a vaccine for HIV for decades, and that's been impossible to do. But with so much effort going into this, we think there's a reasonable probability that there will be a vaccine. But as I said, one of the key hurdles is understanding what the safety is of these vaccines, because it's not, a vaccine may have efficacy, but we want to understand what the long-term safety is. So for me, I think that it's quite reasonable to think that it will be at least 12 to 18 months, if not much longer than that, to establish the safety of the vaccines. And the issue that you brought up, which is the manufacturing, that it depends on the technology that is used to develop that particular vaccine. There are some technologies that are being looked at that could lead to very rapid manufacturing. There are others that could take much longer to scale up, and especially for the numbers that you're talking about. So it's, again, I would say that we should not expect a vaccine in the next 12 to 18 months. There are many different factors to consider, which include manufacturing, but I think you have to think of it as all of these factors put together.
Eric, and then just staying with you and somewhat on that theme of, you know, like if you listen to the news, it's always about the best case scenarios, but to your more pragmatic, admonition, assuming that there is no vaccine, and given sort of where certain states seem to be relative to opening up the economy sooner rather than later, what's the worst case scenario?
Well, that's an important thing to ask. And one of the things that has been brought up recently is the potential for a second wave. And I think it was Dr. Redfield from the CDC who was in the news over the last couple of days warning about a potential second wave this winter, which could coincide with the seasonal flu. And so if, I think of, I don't know the worst case scenario, but a negative scenario would be that we have this lingering COVID in the population. And I mean, I think you could expect to say, even if we do very well with containment in the US, there's probably going to be a substantial amount of lingering virus globally. And so there's going to be continued circulation. And so one of the really negative scenarios would be that it comes back in the winter along with seasonal flu. And one of the reasons why it could become seasonal the next time around is because the first wave, which is the current wave, nobody had antibodies to this. Nobody has been exposed to this virus before. So it was not occurring relative to a normal seasonal pattern. But in the second wave, if it were to come around, we could have that seasonality, which would coincide with seasonal flu. So the hope would be that if that were to occur, that we would have put all of the criteria in place to be more prepared this time. And hopefully in the US, we would look more like South Korea. And we would have a lot of diagnostics. We would have sufficient high quality PPE. We would have contact tracing teams in place throughout the country. So all of that's something that we need to be thinking about into the summer and fall, and the country needs to be prepared for.
Thank you, Eric. The next set of questions is for Jim and Brad. Jim, you mentioned how both the fiscal and monetary policies were timely and at least for the moment sufficient. What would you attribute to that? Is it because we have experienced 2008, 2009 great financial crisis so recently, or was there political alignment at the federal level? And if it is a factor, if politics is a factor, assuming that there's a change in Congress or the White House and there's different parties in charge of one end of the Pennsylvania Avenue or the other, what does that speak to 2021?
So I'll offer a couple comments, and if Brad wants to add something, he is welcome. I would modify slightly the phrase that both monetary and fiscal have been sufficient. I think monetary has been sufficient, and the fact that Brad mentioned how the liquidity has improved so significantly in the markets is evidence of that. It's too early to know if the fiscal is going to be sufficient, but one thing that we have believed, and it ties into your questions about why has this worked and what is the political atmosphere, is that we felt that it was going to be a political loser for either party to stand in the way of fiscal support for either workers or employers. It is really the government's responsibility that these businesses have been shut down, and so that's why there really hasn't been any hesitation to support the people. With a change in government, if there was to be a change, I'm not sure we would see significant difference there. Where politics are coming into play might be in an area, for example, of the energy companies. I think the Democrats right now would have a hard time getting unanimous support to do significant support to the carbon-intensive oil and gas business, for example. So that's one way that the politics may play out into this going forward.
And with respect to the monetary side, I don't think it was political at all. The Fed didn't have a choice to maintain credibility, and it threw everything it could at the market to get it moving again. And so they cut rates 50 basis points and 100 basis points. They introduced new programs. Expect them to introduce and tweak programs to keep the market functioning and keep investor confidence in the market. The last thing the Fed wanted to do was credibility, and if they lost credibility, the situation would have been a lot worse, not only for the economy, but for the markets.
So we have another question. While the fiscal and monetary responses were encouraging and effective, do you believe that the market rebounds fully reflect the real damage that this pandemic has caused our economy?
Boy, that's $1 million or $1 trillion question. I think what the markets are reflecting today is an expectation that there will be a reasonable control of a return to the virus, and that the economy is going to slowly crawl out of this hole over the next several quarters. And so it is absolutely pricing in some recovery. And the risk factors which we've highlighted are that the amount of fiscal support proves insufficient because we do have a worse expected return of the coronavirus. So I would say the markets are pricing in this being a relatively manageable recovery from here. There is a chance that the virus doesn't come back significantly in the fall. You have to assume that it does and plan for that. So there are scenarios that could even turn out better than this, but I would say that's you're probably better off focusing on mitigating downside risk than you are positioning for upside potential.
If you look at the fixed income markets about expectations around growth and inflation, given the current level of rates, it's not indicating a significant rebound in growth or inflation. And it's our expectation that rates even move lower, as I said. So, you know, the long run drivers of interest rates are growth and inflation, with them really low right now and not expected to rebound at least for several quarters, as Jim mentioned. You know, it's going to be hard to get any clarity about how risk assets should be behaving. But the good thing is we have that mitigant, which is both a monetary and physical stimulus.
And the one thing I would also add to this, because we get this question frequently, why are the markets up? One, I would say that there's two factors. Number one, or three factors. Number one, the people that were way out of position have sold and have gotten into a more defensive position. The second is people rebalanced. And the third is people who are looking out with an intermediate to longer term horizon are making the bet that they're going to get a better intermediate to long-term return out of risk assets than they are out of investment grade bonds and out of treasuries and other sovereign bonds. So it's really important to look at the time frame here. Over the next 3 months, could we have another big return of volatility? Absolutely possible. The market's not positioning for that. It's positioning for the intermediate to longer term.
Great, thank you. Once again, Jim McDonald, Brad Camden, and Eric Nossi. Thank you again for your time, your expert presentation, and your words of wisdom. And thank you to the audience for joining us today. Our next webinar in our Enhanced Center for Online Learning is scheduled for Tuesday, April 28th on the topic of, do public sector employees really live longer? Thank you, everyone.